Imagine your main business gets cut almost in half, container traffic at your home port down 65%, and in the same 3 months your profit doubles. That's not a typo, that's exactly what just happened to AD Ports Group. Its best ever quarterly profit landed at the precise moment its Abu Dhabi ports were being crushed by the Strait of Hormuz conflict. Today we explain how a company survives losing two-thirds of its home cargo volumes and still prints a record, because this quarter is the clearest real-world test of diversification you will ever see. Officially reported second quarter revenue rose 47%, EBITDA 49%, and net profit jumped 88% to a record. And for the half year, profit is up 64%. My read, on the surface, a blowout, but the how is the entire story. Because underneath that record, one part of this company was in crisis, another was having the best quarter of its life. Let's start with the half year because every top line number is a record. Revenue, EBITDA, and profit all up sharply, and critically, profit grew faster than revenue. My interpretation, that's operating leverage, lowering financing costs, and stronger joint venture contributions, all amplifying each extra dirham. This is more profitable company, not just a bigger one. Now the paradox, and this is the heart of it. Fact, at the Abu Dhabi ports, container throughout fell 65% and bulk cargo fell 67%. The ports division's revenue dropped 17% and its profit 23%. By any normal measure, that's a disaster quarter. And yet the group posted a record. How is that even possible? Here's the answer, and it's elegant. The very same conflict that shut down the ports sent global shipping rates soaring. And AD Ports doesn't just run ports, it runs a large and fast-growing shipping fleet. Maritime and shipping revenue jumped 62%, its profit 79%, and it's now the group's biggest earner at over half of revenue. Freight rates on key Gulf and Indian subcontinent routes nearly doubled. International container operations more than doubled. My read, the same disruption was a curse for one division and a windfall for another, and because AD Ports had doubled its fleet over the past year, it had the capacity ready exactly when rates spiked. Zoom out and you see 4 business clusters. 3 were growing hard, shipping, logistics up 30%, and the economics zone's business signing land deals and selling assets. Only one, the ports division, was under fire, the one most exposed to the regional situation. My interpretation, that's diversification doing exactly what it's designed to do. When one leg buckles, the other carries the weight. And the financial position is healing while this happens. Leverage actually fell. Net debt to EBITDA improved to 3.7 times from 4.1. Operating cash flow more than doubled, and that's no major debt maturity until 2028. My read, this record isn't debt-fueled or one-off engineering, it's self-funding. Management even made a striking point. If you count all shipping as international, this is really a two-thirds international business that just happens to be listed in Abu Dhabi. But be honest about what powered this. Those shipping rates are cyclical. The plus 96% spike that drove profit can reverse just as fast when trade routes normalize. The ports only fully recover when the Hormuz situation eases, and the blended margin actually dipped because shipping revenue is lower margin than ports. So profit soared even as the margin percentage slipped. My read, none of this breaks the story, but it means this exact profit mix may not repeat. Does management sound confident? Very. They held full year guidance straight throughout the disruption, doubled the fleet, and lined up an acquisition. GFS, that should add roughly 10% to revenue and 16% to EBITDA. The CEO's framing diversification was a deliberate choice years ago, and it's paying off precisely when we need it the most. My assessment, this quarter strengthens the long-term story in the most convincing way possible by proving the model works under real stress, but the smart investor watches the two-sided nature of it. Before next quarter, watch the 3 things which reverses first: recovering ports or fading freight rates, whether shipping rates hold or mean revert, and whether the GFS acquisition closes and integrates on plan. The record is real, just remember it was born from a crisis that cuts both ways. Home port cut in half, profit doubled, guidance held, a masterclass in why diversification matters. That's AD Ports this quarter.